let's connect with Niket Shah. He's live with us in the studios, and Niket Shah is the CIO of Motilal Oswal. Hi, Niket. Very good afternoon, and great to have you with us today. But the big event everybody is watching out for, Niket, is indeed the budget. So we have to start asking you, what is the expectation from this budget? Which sectors are you keenly tracking, or you're hopeful that the government should have their eye on? What's the sense that you're gathering?
So I think, while the anticipation is that, this budget is going to be a little more on the populist side, given how the election results have really transpired, our sense is that they will continue to focus on fiscal prudence. I think the 5.1% fiscal deficit number, which is likely to come in FY25, can be positively surprised, as far as the government is concerned. We don't think they will dial down on fiscal prudence. I think fiscal prudence is paramount to this government, in our opinion. And from a sectoral standpoint, I think manufacturing will continue to be key focus area, as far as this government is concerned. Yes, you should see some rural benefit or some stimulus being given to the rural sector as such, but nothing material. Because I think a lot of the freebies are already being given by the state government right now, as we are talking, right? Wherever there are elections in the next few months.
Absolutely, so obviously those MSP sides and everything has already started coming in. Anything specific in terms of sectors you're watching out for, or one should keep an eye out on? If that capex story may continue going forward, then what is it that we should be keeping an eye out on? Because some of them have already seen a run up. So where is it that you should watch out for?
So I think it'll be more of same. I would say that obviously allocation to defense moves up, allocation to rail moves up, because obviously it has significant impact on the rest of the economy, right? So I think the government push on infra continues. I think my only thing is, which might be important to look in this budget, is the focus on export. So till now, most of the manufacturing companies were making it for India. I think the government will really push where you make in India, but you now make for the world as well. So I think that is an important thing to really watch out for in the budget.
Niket, I want to know one thing. While obviously railway defense side, we are seeing that, the allocation will continue, everything will continue. But these stocks, look at any of the names, doubling almost in 1 year, more than that, if I may say for some of the names. Isn't it a bit too scary to enter right now? Or what would you look at there, or how can you enter at this level? Is it still value?
So I think if you look at it from a defense standpoint, I would say that the runway of growth is still very, very large. Most of the companies have very strong order books, right? So the runway of growth is large, but for sure, I think the valuation for sectors like defense and rail are definitely on the higher side. Specifically on the rail, it's very difficult to make any logical conclusion of how some of these valuations have really gone through the roof. But on defense, I think that the valuation is still reasonable in some of the larger cap names. And I think the runway of growth continues to remain fairly large. As I told, I think the large part of the opportunity for defense is now looking at the export market, which is another driver of growth, which I think a lot of people haven't factored in today.
All right, but Niket, definitely we had your take on the budget side, but earnings is something which drives the longer term growth, and we are amidst of the earnings season as well. So Niket, any sector that you believe that could be in for a turnaround? And also I want to have your take on the consumption side as well, because you just highlighted that there could be some steps, but in the last earnings season, I believe that it was the re-rating sort of a thing that happened for the consumption pack. So do you believe that this could be a story of the year maybe to look out for, and what's your take on that?
So I think the story of the year, in our opinion, is going to be IT.
Right.
We believe that, initial part of this year, we said this year telecom will be the highlight of the year. Our sense is that we are getting into a situation where a couple of quarters down the line, IT would really surprise all of us. We are significantly overweight IT, about 14-15% overweight position on IT is what we've made, before the quarter really started. In fact, in last quarter itself, we continue to believe manufacturing will do extremely well for the next 2 to 3 years standpoint. I don't think that's slowing down either ways. And consumer discretionary, I think it's in a very sweet spot as well. So I think these are the three things that we would really go, overweight on.
Okay, and in IT also, specifically mid-cap IT, is that the bet, or large cap also starts looking attractive now?
No, I think mid-cap. So largely mid-cap and small cap. I think large cap, obviously, growth rates are far lower, and mid-cap and small cap growth rates are far higher. Some of the companies obviously will be biggest beneficiaries of AI as you kind of see that rollout happening into next year. So I would say that we would really stick up to mid caps and small caps.
But Niket, given the movement in the markets, there's been no stopping. Just the last week, I think that there was some turbulence. But even with respect to the budget and the earnings, at least for today, the things are holding up well. But do you believe that there are some concern, or there are some pockets in the mid and the small cap end of the market where investors should be concerned, or you believe that the valuations are a bit justified and the India long-term story is just intact?
So I don't think the bull market is ended, right? But I think bull market is made of consolidation phases. Look at 2002 to 2008. There were 7 occasions where market corrected by more than 10%. 2 occasions where market corrected closer to 30%, right? And still for us, that's probably the best bull market that we've seen, right? From an earnings standpoint, we're clearly seeing slowdown in earnings, right? This quarter probably will be the worst earnings growth in 16 quarters. Right, we're seeing like what 3 or 4% kind of earnings growth for large cap names, and probably 5 to 6% for mid caps. So I think we have started to see slowdown in earnings, and in context of that, obviously valuations in certain sectors continue to remain extremely elevated. So like for example, look at manufacturing. Within manufacturing, there are multiple cuts. Of that, one of that is capital goods. We have taken a call that at 70, 80 times multiple really doesn't make sense. So we have gone underweight on capital goods and overweight on IT, where it looks like the tailwind is about to begin. So I think that's how we would navigate the cycle. But yeah, from an earnings growth standpoint, it's quite concerning. And I think we should get into a consolidation phase, at least for the next 3 to 6 month period.
Okay, so the next 3 to 6 months may be some bit of a consolidation. But chemicals, I want to understand on that, right? That story has not played out in the last year. And they were expecting that now maybe we could start seeing an improvement coming in terms of the earnings, the performance for the company. Do you think that's a story that one could watch out for, or maybe because of the global tensions and uncertainty, you would still be wary?
So I think if you look at the chemical space, it's quite interesting, because what is really transforming on the chemical side, in India, there's a lot of buzz on EV chemicals, and semiconductor chemicals, and so on and so forth. But our sense is that we would love to stay away from them for a long period of time. And the simple reason is China is expanding capacity for most of them at 2x in every 6 month period, right? So when you have doubling of capacity for most of them in China, and the price erosion has been more than 50%, it becomes extremely difficult for large chemical company names present in that space to become viable at global scale, right? So we would love to stay away from that. So essentially now, how do we look at chemical space? We will look at companies which are more focusing on CRAMS business, right? Where a large US customer gives them an order and they supply over a period of time. And the second is that you look at companies which have products where China is a very small part of the portion, right? So companies, for example, are manufacturing phenol, where China is there, but it's, Indian guys are also, large enough, right? So similarly, from a product to product standpoint, you have to look at companies where China is not a competitor. If China is competitor, and some of these new themes, which are very exciting for larger investors and specifically on social media, we would love to stay away from that.
But also help us with your take on the financials as well, Niket, because that could be called the growth engine of the economy, and nothing can go without the growth in the financials. We just had the numbers of HDFC, Kotak Mahindra Bank, and some concerns on the deposit growth is what the management is highlighting. Even the numbers were not that fascinating. But do you believe that this quarter or a couple of quarters we could see we should be in for some such expectations or this sort of an outlook, and then maybe financials can have a push? What's your take?
So I think the credit growth will continue to remain in the range of 13 to 15% for the next couple of years. I think the challenge really is on the P&L side. Right, we will see NIM decline because we have not even seen an interest rate cut environment, right? Yeah. So the next 12 to 18 months, we will see, a NIM decline. Credit costs are, I think, clearly bottomed out. So from that standpoint, from a profit after tax growth for financials for the next 2 years or maybe 18 months, looks fairly lower. So it looks like a single digit kind of a growth. It's something which doesn't excite us.
But this is the time to accumulate, stay away, or
I would stay away, wait for the interest rate cycles to bottom out. Right. I think we need an interest rate cut, and I think hopefully by next year we should see an interest rate cycle bottoming out.
Okay, Niket, thank you so much for joining in with us on this very rainy day, enjoying, but hoping next time we meet, we'll meet over bhajiyas when it's raining.
For sure.
And hot tea. But thanks so much for joining in with us on the studio.
Thanks for having me.
Thank you.
Thank you.
If you like this video, then like, share and subscribe to ET Now.